For an economy that isn't entirely out of the woods yet, a massive run-up in stock prices is bound to raise questions. Back in May, RBI Governor Shaktikant Das had warned of a bubble in the stock markets as India was still fighting a second and more severe COVID wave. His warning, however, fell on deaf ears. Since then, the BSE Sensex has soared 12% while the Nifty 50 has advanced around 11%. In absolute terms, the BSE barometer of India's top 30 shares is atop the 57,000 mark, and the broader 50 share index is holding 17,000 levels. Strong domestic inflows, hopes of a strong revival in the economy and therefore corporate earnings, coupled with the US Federal Reserve's assurance that an increase in interest rates is still some time away, has given ammunition to the market bulls. No wonder then that the index of 50 blue chip stocks took just 19 trading sessions to scale the latest 1000 points. However, within these factors, a substantial retail participation has been one of the biggest driving forces. Let's take a look at some figures. Retail investors now account for 45% of cash market volumes, with direct ownership at a 12-year high. Further, household investors purchased equities worth $5 billion in the June quarter. Compare this with FIIs, and you see a reverse trend. FPIs began investing aggressively in bonds for the first time in August 2021. In the past month, they bought bonds worth 12,144 crore rupees. In contrast, equity buying has stood at 2,083 crore rupees for the month. So, should retail investors take cues from their foreign counterparts and recheck their portfolio? Is equity investing getting riskier? Let's find out. According to analysts, stocks face plenty of potential risks that could dent the rally. The US Federal Reserve's policy changes, the spread of the COVID-19 Delta variant, and geopolitical risks may lead to a pullback in the rally, they say. Recently, Jyoti Vardhan Jaipuria, founder and managing director of Valentis Advisors, told Business Standard in an interview that as we had not seen any big correction since March 2020, so a time and price-wise correction could be due. Given this, should you invest in equities or go for bonds? We have with us Anil Sarin, Chief Investment Officer at Centrum PMS, to answer these questions.
As you asked yourself whether we should be investing at such elevated levels or that we should be investing at all, I think the answer is yes to both, only the context differs. Whether one should be investing in equity, absolutely you should, because it should be part of your overall asset allocation based on your risk assessment. But even if you are an older person who is risk averse, a little bit of equity investing is desirable because the alternative sources of investing do not give you anywhere near the kind of returns that equity provides. So to answer whether one should invest in equity or whether one should invest in equity at these elevated levels, my answer would be yes to both. Now, having decided that you do want to expose your portfolio to a little bit of equity risk even at these elevated levels, you need to be cautious about a few things. First and foremost, stop investing with borrowed money. At these levels, it is not good for you. It's very, very risky. Second, as far as possible, do not invest in unknown names based on tips or under-researched names. Let that be done by people who have better information or people who do that for a living. If you are not a professional investor, it is not advisable at these levels of the market to be going for those very, very small, unknown or tip-based kind of investing. Third, I would do a fair amount of research before putting money to work if I want to do it directly myself. I would recommend, as an investor, I would recommend that you go to sites like YouTube, which has a lot of material on a lot of companies, and some of the quality over there that I've noticed is actually quite good. And then there are all these newspapers and websites, etc., which are devoted to it. So do your work before you invest. Do not invest based on hearsay, based on what your friend has invested, based on what some big well-known investor has been putting his money into. Do your own work and only then go ahead with investing.
But what if one is not well equipped to do the research? How should you invest then?
Now, if you do not have the time, or you do not have the ability or the inclination to do your own work, then it is best that you let it be done by a professional. Some fund manager in a mutual fund or in a PMS or etc. Can do a better job for you under the circumstances that I shared, where you can't do it yourself. If you still want to make direct investments and not go through an expert, then I think the way open for you is to go through the ETF or the index fund route. That is something which is very easily accessible by everyone at a low fee structure. You can get exposure, and over long periods of time it has been seen that even the best of fund managers struggle to beat the index. So my advice would be to stay invested in equity. Do not worry about the elevated levels of the market that there are. Over a long term, all these things will be taken care of. But trying to time the market, saying that the markets are elevated and I want to be out of it, etc., that would not be in your long term best interest. So, and to the extent that you don't know exactly how to do it yourself, let an expert do it. You still want to do it yourself, do your research. If you cannot do that, then go through the ETF route. That would be our advice.
Meanwhile, Deepak Jasani, Head of Retail Research at HDFC Securities, suggests 7 golden rules, especially for retail investors, to safeguard their portfolio at current levels. Listen in.
Retail investors, old and new, are having a good time in markets lately, with Nifty touching new highs every now and then. However, one should not get carried away by this bull run and keep following simple principles in mind to avoid shocks when a sharp correction begins. 1. Be careful in giving higher and higher valuation to growth stocks, especially in sectors that are linked to commodity cycles. A sharp correction could knock off a big portion of their valuations. 2. Even in value stocks, they will have to be careful to check as to how much will the future cash flows be impacted by the changes in macro situation and emerging competition from disruptors. 3. Solid defensive stocks can be relatively safe, and even after corrections, this can come back to your entry level quite quickly. 4. Maintain your asset allocation among asset classes. In a bull run, often the weight of equities rises sharply. Profit booking at intervals and diverting these funds to other safer asset classes helps in maintaining this asset allocation and avoids the regret of not booking profits in a bull run. 5. Closely monitor the risks to the bull run, including the interest rate scenario globally, end of easy monetary policy, monsoon progress in India, commodity price cycles, inflation, and other macro numbers in India. 6. Keep better quality stocks in your portfolio and avoid going for the trap of turnaround stories in lower quality stocks. 7. In the current times, they should avoid applying in IPOs just to make listing gains. Only when they are convinced about the business prospects and the reasonability of valuations should they apply in such IPOs.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.